So good morning, everyone. Welcome, and thank you for joining this press conference. This press conference marks the launch of a new ESM publication, the Euro Area Stability Watch. My name is Cedric Grillo. I'm the chief spokesperson at the ESM, and I'm joined today by Rolf Strauch, the chief economist at the ESM, and Pilar Castrillo, who is leading economic and market analysis in the economics department at the ESM. And Rolf will start with the presentation, and he will present first why the ESM is launching this new publication, and second, he will walk us through its key findings. After the presentation, there will be a Q&A session. Rolf and Pilar will take questions. And we also have a few authors here in the room who are willing to take specific technical questions at the end of the press conference, but I will get back to that later. I would also like to add that Pilar led this exercise. She played a significant role in the production of this report. But for now, Rolf, you have the floor.
Welcome to the launch of the first Euro Area Stability Watch. You may ask why yet another report by a European institution. The report does what the name says. It keeps a watchful eye on the financial stability of the Euro area. And it asks what happens if things go wrong rather than what will happen. And we think that's an important question. It's an important question for us as a crisis resolution mechanism because we want to anticipate shocks and we want to be prepared for future crises. And that is close to our mandate. The work that we present in the report complements the work from the colleagues in the European Commission and the European Central Bank. And it puts a specific focus on the vulnerabilities and risks of the euro area and spells out the fiscal implication that those carries. And we think it's a particularly important question to address and a particularly important aspect to focus on in this global environment that is marked by increased uncertainty. Now, the report has two chapters. The first chapter provides our assessment of the risks to the baseline economic outlook as it was presented by the European Commission in the spring forecast. And the second chapter does a deep dive into defense as one of the key topics that nowadays structures financial stability and structures sovereign risks. We plan to publish the report annually around this time of the year. Let us now turn to the report that will be released at 11 o'clock today. The main message of the first chapter is that resilience is coming under strain. In this current environment, we see indeed a confluence of challenges for the euro area. We have security threats, we have frictions in the global trade, disruptions of energy, and financial market volatility. All of that puts strains on growth and public finances. So, will the euro area, in view of those rising risks and diminishing fiscal buffers, be resilient? The report gives a clear answer. It says that rising risks and higher support, demand for support from the public will put financial stability and debt sustainability under pressure. And that implies that policymakers will have to take clear choices because they will have to embark on fiscal adjustments in order to safeguard the credibility of the European fiscal framework. And having that credibility is very important because otherwise financial markets will determine the fiscal space that governments have available. And we have learned in past crises that this is an uncertain and inherently unstable place to be. So let me dig deeper into this chapter 1, which has two parts. The first part that present the risk and vulnerabilities, and the second part that talks about the fiscal implications. When we look at the euro area, fortunately, we see important strengths that underpin resilience. That is record high employment, a well-capitalized banking sector, and solid backstops. These will continue to underpin resilience. But at the same time, next to those three strengths, we see three vulnerabilities. And here first we have the diminishing and eroding of the fiscal space. And defense spending is a strong part of this. In a few minutes I will explain how defense spending can be done so that over time it partly pays for itself. The second vulnerability is that the region remains exposed to energy supply disruptions. And here, of course, the main risk is geoeconomic uncertainty and geoeconomic tensions. Those lead to higher energy prices, uncertainty, they undermine competitiveness and investment, and therefore, in the long run, also growth and productivity. The third factor is the close linkage of financial assets and liabilities with the United States. And this financial linkage implies that European investors are exposed to possible losses. And those may occur both with a view to equity and US treasuries. We know that US equity prices are still stretched. They're built on expected earnings for artificial intelligence related investment. At the same time, we see that sovereign bond markets now have a higher share of investors that are highly price sensitive. And at the same time, many of them are located abroad. That means that in the future, markets may become more volatile. The escalation of geopolitical tensions is actually high in the minds of future risks for the euro area by investors. And we have conducted a survey actually for this report where we have asked investors how they look at the world. And you see it in this chart what the outcome is. And you see in the chart that more than 3/4 of investors think that geopolitical tensions is one of the major risks that we are facing. The ESM as an issuer and investor is daily in the market, and we have an ample network of investors that we collaborate with, and we use that network in order to bring this element of market intelligence to the report. To better understand these risks, we present a scenario where we specify how shocks will affect the macroeconomy and fiscal conditions and how they would worsen when they occur. We assume more specifically that two shocks occur simultaneously. The one is prolonged tensions and possible re-escalation in the Middle East that would lead to higher energy prices and extend uncertainty. We are obviously well aware of current developments and that probabilities for this to happen change. It's still an important risk to consider and to think about the implications of that shock. The second shock that we look at is a strong loss of value in US assets. That would imply a tightening of financial conditions, and at the same time it would transpose losses to European investors. Each shock by itself would already be challenging. The two shocks combined, in our view, imply that the euro area would be pushed towards a recession and that inflation may be up to 5%. From our perspective, there are even long-term repercussions. The euro area would lose about 2% of GDP compared to past trends. That is about the magnitude of Finland's GDP. We also find in our analysis that big shocks have a disproportionately large effect on the economy, more than smaller tensions. The reason is that it mainly works through investment, and continued weak investment implies that there are scars in the economy, and those effects become more protracted. That is also why we think that European growth initiatives, and here specifically the Savings and Investment Union, are very important. Another insight from the analysis is that The current situation differs from the sovereign debt crisis, the situation that we had in 2010. At that stage, it was mainly the fiscal position that was a determinant of the vulnerability and repercussions. Nowadays, the vulnerability emerges mainly from energy dependence and trade openness, so there is a difference. It also implies that small open economies are more vulnerable than others. So, what does all of that imply for fiscal policy? And I will now dig a little bit more into the second part of the first chapter. And let me start this off by pointing to the main message of this chapter. And for that, use Willy Brandt and paraphrase him when he said, "Credibility is not everything, but without it, everything is nothing." And what it means is that a fiscal framework gives flexibility and time, but only as long as markets trust that you will actually use this wisely. When we look at the repercussions of the two shocks that are outlined and the economic implications, there's also obviously a big impact on fiscal policies. And in our exercise, we find that public debt, when those shocks occur, would be 20 percentage points higher than under the baseline. And the debt trajectory would, for most euro area countries, would be upward sloping. Obviously, addressing this implies large adjustment in a number of euro area countries. And you can see this in this chart here. It shows what countries will have to do in the future in order to safeguard debt sustainability. You see that the amounts are very large, up to 10 percentage point of GDP. When you look at the chart, you see essentially that there are different drivers. And on the right-hand side, an important element of big fiscal adjustments that are needed is the current fiscal situation. Moreover, you see in the bars that are related to the adverse scenario and the impact that it has, that it is bigger for those countries, as I said before, that are small and vulnerable. And this has to be kept in mind. These adjustments effectively, for half of the countries, exceed what has been done in the past. And that is an indication of the challenge that they face. And that is essentially what we mean when we say that sustainability is put under strain. When you're in such a situation, it strengthens the case to look at the quality of public finance. And here we associate ourselves also with the call that crisis measures actually have to be targeted, timely, temporary, and tailored. This is more efficient, more cost efficient than having broad-based measures to deploy to the economy, such as general reductions in tax rates. Looking at the situation, it's essentially rebuilding buffers, spending efficiently, and advancing structural reforms that are the factors that drive growth and resilience. And this will require tough choices forward-looking. As a euro area safety net, we can prevent liquidity strains from turning into solvency fears. And we do this through credible insurance instruments, and here above all, our ESM precautionary arrangements. Now, let me turn to the second chapter of the report that is more topical. The euro area safety situation has experienced a landslide change in the current environment. And what it means is that Europe has to spend more on defense, and that is what governments have decided to do. That spending is necessary, but it matters a lot how you spend your money. And one of the key results of the report is that when you spend your money wisely, well designed, and you take account of a European dimension, big part of that spending actually can finance itself. And more specifically, you see the result of our analysis, which shows that And with productivity spillovers, 53 cents of each additional euro spent can in the long run be recovered through higher growth and taxation. And that compares to 25 cents when you don't have those spillover effects. So it doubles the effect that you can have. What does it mean spending is well designed and has a European dimension? And we have essentially 4 factors that determine the fiscal payback. The first factor is how money is spent matters as much as how much is spent. Defense spending generates productivity spillovers, leading to stronger economic impact if you actually provide that money and spend it on technology and innovation, if it allows civilian companies to actually improve their production, and if you focus on research and development. In turn, if your money goes mainly to personnel, maintenance, and buying supplies from abroad, the growth impact is much less. The second element is how defense spending is financed matters a lot. And here we see if you can reprioritize spending within a given budget envelope, then actually this is more growth friendly than increasing taxation, and particularly more growth friendly than increasing taxation on labor. The third element is whether defense spending has a European dimension. And with that European dimension, we have in mind procurement. Procurement should be broadly sourced within Europe. When you do so, this will allow European countries to actually deploy their comparative advantage, build a comparative advantage, and then strengthen the single market. That should help overall efficiency. The second element of a European dimension is that you should respect the guardrails of a credible fiscal framework. As we have argued before, when you have credibility, it lowers costs. So having defense spending integrated into well-designed national programs and observing what the European fiscal framework says helps lower that cost. For now, I leave it here and back to Cedric.
Thank you very much, Wolf, for these very thorough explanations. We now have a Q&A session. I will first take questions from the room and then join online. Please, when you ask your question, state your name and outlets. Jorge.
I have 2 questions, but before that, just a quick clarification. You say that inflation rates almost 5%, but then in the report I didn't find the 5%. It was more like 3.7%, if I'm not wrong. So if you could clarify which is the right figure. And then when it comes to the question, so first, you spoke a lot about the credibility and the fiscal framework. In light of these 2 kind of exceptions that the Commission gave based on defense and now more recently on green energy, would you say that how the Commission is implementing the rules is projecting that credibility? And then the second question is, when you compare the current situation with the past situation of the euro crisis, you said that they were different in nature because one was due to the fiscal situation and now it's more the external circumstances. But would it be the case that, in fact, I mean, in both cases, it was due to the kind of fiscal situation of the crisis of the countries, but then the trigger was different. In one case, the banking sovereign loop, and in this case, the external factors, which are, as you said, the energy crisis and the the AI volatilities.
Do you want to take those 2?
Yes, I can take those. First on, you asked for the 5%, and here I show again the chart that we also have in the report. And indeed, if you look at it, so on the left-hand side, you see first that in the adverse scenario, GDP would go into recessionary area. And on the right-hand side, that indeed, according to our estimates, inflation could go up to 5%. Obviously, this scenario is under what we call a no policy change assumption. So we do not factor in the ECB the ECB policy, monetary policy, nor corresponding fiscal policy changes. That is important to note, which we think is prudent to do, but obviously when there would be a monetary policy reaction, then you would have higher interest rates, and that would also feed into the economy.
Pilar, you want to add to this?
Yes, just to complement, the 3.6 that you mentioned is the annual average. So here you see that it peaks at 5, and the annual average that it's in the report is the 3.6.
Then you had a question on the national escape clauses and the European fiscal framework. Again, indeed, we think that the European fiscal framework is very important. It was also necessary to address the security concerns and allowing for the national escape clauses to kick in, because we need security and we need to have the necessary spending. The Commission has later on decided then to broaden somewhat the expansion that can be done under those national escape clauses, but also applying them to environmentally friendly and energy saving measures. This is a decision of the European Commission that does not broaden the overall envelope that was created. But we are also very conscious that one must be mindful in what you do to the framework, because in financial markets this can be read indeed as a weakening of the overall framework. For us, the key point is that even if you do this now, you need to have a forward-looking perspective, and we need to build on the framework forward-looking. That is why we are also spelling out now the challenges that will emerge and how eventually you have to adjust. So even if you use the space forward-looking, you need to adjust your budgets in order to include those spending items. The third point that you had was on the sources of a crisis and the argument that the vulnerabilities have changed. If you look at that chart that I showed on the fiscal implications of the adverse scenario, you see indeed that those are bigger in small countries, which is not surprising because their economies are more affected. Obviously, there is the point that, and that also what makes the report relevant, is that at some stage, forward-looking, not now, but at some stage, obviously, there can be a point when this is combined with broader concerns about the debt situation of a country. And then obviously that will at that stage also become by itself a driver potentially of financial instability. So, but the origin of the crisis or the origin of the vulnerability that we see now is a different one.
Thank you, Rolf. Jakke.
I'm Jack from Politico. A little bit of an existential question, if you let me. I mean, you mentioned obviously the ESM is the safety net, of course, but obviously the legacy from the sovereign debt crisis is that you do carry somewhat of a stigma, to the point that, you know, there's your treaty is still stuck in Italy, and you can't be upgraded until that even goes through. So I'm just wondering, how are you guys trying to address that stigma so that things like your credit lines can actually be used without any real fear?
So first, let me say indeed that this report is we see this report as part of our work as a crisis resolution mechanism, because part of our mandate is also to think about the prevention of crises. And that is what this report is about. It's meant to strengthen overall resilience and crisis preparedness. Now, on our role and the ESM being used, we have obviously thought about the issue and the question of potential stigma. We have discussed this also with member states in our review of the toolbox that we have discussed. And we are thinking about possible solutions that can, for example, also entail the possibility that member states as a group maybe sign up to a precautionary arrangement if a common threat emerges. So it's part of our thinking to overcome that issue and part of the practical approach that you would have to take in a crisis.
Thank you. There are no questions in the room anymore, so we'd like to move online if there are any questions.
Thank you for the briefing. Just the figure that you have in front of us, the fiscal constraints require difficult policy choices. There are small exposed countries on both sides. So do I read this rightly that the risk exposure is more on the left side now, because these are just to prevent that I misunderstood this. Second question is, what do you recommend to member states if you talk about fiscal adjustments? Do you just think about debt reduction to have a little bit more leeway and space, or do you have other things in mind? And the very last thing, ministers are always talking about 2028 as a cliff, because then some European programs have to be repaid. Do we see that cliff as well as an extraordinary challenge? Thank you very much.
Thank you. Rolf?
So on the first point, when you look at the impact of the adverse scenario, so it's the light blue bars, and you see that those can be big for countries, or are big in our estimate for countries like Slovakia, Slovenia, but also if you move to the right-hand side, Bulgaria, Latvia. In the report we have also a very nice chart that shows the exposure to the energy dependency of countries, and there is actually a correlation. So with the right-hand side of that chart, so a higher energy exposure means higher vulnerability. There is the difference between the left-hand side and the right-hand side on this chart, as I said before, is what we call here the baseline. The baseline means the adjustment needs that emerge from your current situation and the forward-looking path of interest rates and growth, the interest rate growth differential. So if you have a high deficit or high debt at this stage, and your interest rate growth differential is such that you don't grow more than your interest rates, that means that the dark blue bar is actually bigger. And that is the difference between the countries on the left-hand side and the right-hand side by and large. That is why some countries that are small, but at the same time have less of a current fiscal issue, are from that perspective less of a concern, or will face less adjustment needs. That was the question on the adjustment. And I must admit, I have not fully understood the 28 gap. Is it that when national escape clauses end, that countries fear that then they will face a gap? Can you please quickly repeat? Well, there are 2 points. There are 2 points that will emerge. A, the Next Generation EU program will end, and the other point is that the national escape clauses will expire in 28. Both puts a challenge on governments, and it comes back also to the question of the adjustment that you asked. It is not our role and not the task in this report here to devise concrete adjustment plans for countries. That is actually done in the country-specific recommendations by the European Commission. But what we can say actually addresses those points as a general remark. As a general remark, the report is essentially a call to early think about these later fiscal positions. You now need to think essentially how the world will look when you get to 28. And here we learned from the past that it's very important to keep up investment. Yes, and when the European money will be absorbed, it will be important also for government not to scale down investment. That it means that some space for that would have to be created. The other general element that we see is one needs to be mindful of spending efficiencies, and spending reviews are an important point here. The third element is, and this is a general topic for Europe, is that it's important to also focus on those areas where one can complement, or where the private sector can actually complement and take over tasks that have been done and spending that has been assumed by the public sector so far. And here I come back to this element of the Savings and Investment Union that we mentioned before, because the Savings and Investment Union is meant to absorb and produce financing for the growth of the economy. And here also the capitalization of pension systems are a major pillar that needs to be developed, and that can actually help to save some money from the public purse. So these are kind of a few general elements that we see on what could drive that adjustment path.
Thank you, Rolf. Any other questions online? If not, thank you very much. Any final thoughts from your side, Rolf?
Thank you very much for joining this press conference. Europe will have to shape its future in a more uncertain global environment. And with this report, we want to make a contribution to actually enhance European resilience and its crisis preparedness.
Can you hear me?
Yes, Maria.
Hello, it's Maria Sara with the newspaper Greece. I would like to have your opinion on how exposed is Greece according to your report. I see the figure, but if you could elaborate a little more about the situation and what would you advise? What would be your consultation on the situation of the Greek economy? Thank you so much.
Well, you know that we are following the Greek economy very closely, and we have also pointed out to the gains that Greece has made and the progress that Greece has made ever since you left the ESM support, that Greece is marked by relatively high growth and also you have high public surpluses. And that's obviously a fairly strong starting position in order to face shocks. That is, at the same time, debt levels are high and you need to continue work on your productivity in order to sustain those high growth levels. So the overall point that we see is that for Greece it's good to continue its fiscal prudence and to further embark on reforms to transform the economy and keep high growth levels.
Thank you. Any other questions after Maria? If not, thank you very much. I have two last points. As I said earlier, we have several authors in the room who contributed to this report. So if you have any technical specific questions, they're happy to take these questions. So in the room, but also online, you can stay connected if you're interested. Just note that this is a strictly off-the-record session. And the second point is that the report will be released at 11 a.m. on our website, together with a blog on Chapter 1, infographics, and all press-related materials. So you will find all of this on our website at 11 a.m. Thank you very much for your attention. I wish you an excellent day.